Well, Carter, thanks for making the time today for the interview. Obviously, you come with a deep level of experience as the CEO and co-founder of Revenue Chemists, an agency that helps tech companies find solutions to catalyze growth within their company. As we were just chatting about before, you've had decades of experience in the SaaS space, working with publicly listed companies and then also privately owned companies as well. So it's great to have you here on the Raise today, and thanks for your time.
It's great to be here, Ryan. Thanks for inviting me.
I guess just to get started, would you like to tell us about your background and the impetus behind Revenue Chemists?
Sure. So, a little bit about my background. I had the great fortune when I first started my professional career of working for Xerox. And at the time, it had one of the best sales training and management training classes on the planet, and was fortunate to be there for 10 years. So got this incredible foundation of best practices, processes, all of that, and took that experience and living and working in Silicon Valley, surprise, surprise, jumped into software. And so the vast majority of my career has been living and working in Silicon Valley. I've had the opportunity to scale, more than a dozen companies and been fortunate to have some exits along the way. So, the idea of scaling is really just such a phenomenal problem. And the unique thing that I had was, while I was at Xerox, had the opportunity to scale a team or an organization inside the umbrella of Xerox. And that was really my first taste of true scaling, and just loved the experience from there. And so went on to, make that my passion and focus. And along the way, hired an individual that in the marketing role, and he and I have scaled 3 companies together. And so when we always knew that we were going to form an agency at some point, so we got together and came up with the name of Revenue Chemist, and the rest has been history. We've been out in the marketplace now for about 4.5 years and have enjoyed the process immensely.
Nice. I can imagine it's been a really exciting journey, and definitely you've had access to working with a range of really interesting companies as well. Tell me, with your experience working with various companies, are there any sort of key patterns or anything that you pick up just in terms of optimizing revenue across the board?
I think there certainly are. I mean, look, at the end of the day, every company is a little bit different. But if you think about the process of scaling and, like a sales process or a marketing process, those, probably 80% of them are very similar from company to company to company. And really all you're looking to do is then nuance that 80% to make it the company's own, and to tweak it for the specialties of that company and any environments that they might be operating in. So obviously, if we're selling to oil and gas companies, we're gonna have a very different cadence than if we're selling to maybe Shopify or e-commerce merchants, right? So that 20% is really where a little bit of the magic comes in.
Yeah, nice. That makes sense. And obviously, companies have a choice to hire an agency or perhaps hire someone in-house. Why do you think SaaS companies should work with an agency?
So look, I think in most cases, agencies represent a significantly deeper, richer set of experiences and track record than most individuals have. And so my experience has been, as we engage with companies, we're able to bring, as you mentioned, decades of experience into to the situation. And obviously having, as an operator, scaled over a dozen companies, and then in the agency world, in the last 4 years, we've probably worked with 40 to 50 companies. So that's just exploded the pattern recognition and our ability to deliver value to our clients.
Yeah, that makes total sense. Obviously, you get a lot more focused and honed in on optimizing like a certain area of a business. And as you said, there's like a real pattern matching component that you're able to get as a real leg up against potentially hiring in-house as well. Obviously, there's stages at different companies. And one of the things I'm interested in is understanding what resources or personnel does a company typically require to get the most out of using an agency?
I think I think it's going to differ a little bit on the function that's engaging the agency and the agency itself. But I think, look, there needs to, in my mind, there needs to be two solid things to ensure strong engagement. And the first is a relatively well-defined objective. And I think one of our principles is we see a lot of our competitors diving in and writing these very elaborate multi-page scope of work documents. Our experience is that 2 weeks into the engagement, that scope changes massively because neither party knows what, knows the details, knows the inner workings of the other one. And so what we try and do is coach our clients and our prospects to say, look, let's define at a really high level what we want to do. But then let's, from an agreement standpoint, agree that, if you're not getting value out of engaging us, that you can terminate with 2 weeks notice. And we put that on, we set that up so that both parties can do that. And so our philosophy is very much one of ensuring that we're always delivering value to our prospects. And if the prospect's not getting value, then, we should either find somebody that can deliver the value or we shouldn't be working together.
Oh, that's perfect. I really like that engagement model. I think particularly in the startup and SaaS space, obviously these companies are really nimble. They change frequently, and having an engagement that caters to that makes a lot of sense as well. What do you think the science behind revenue growth is?
I think it's really two things. One, having a very solid set of metrics from which we can understand what's happening in the business. And so we take most of our clients through what we call a demand planning process, where we create a bottoms up spreadsheet that helps us understand at each conversion point, where do we need to be in terms of not only the conversion percentage, but the raw number of accounts or deals that we're working on. And so it creates a really productive conversation between sales and marketing because it's now fact-based. It's no longer a lot of finger pointing where, marketing is saying, hey, we give all these leads, sales all these leads, but they never take care of them. And sales is of course coming back and saying, yeah, all the leads you give me are junk. There's no good ones in there. So this removes some of that ego and personality from the discussion and really focuses it on, okay, as let's say we have a leader of sales, a leader of marketing, as managers, stewards of the business, what do we need to be doing to give ourselves the best chance for success? So we go through a kind of bottoms up planning exercise with virtually all of our clients to help them really understand, to hit a certain level of growth trajectory, what do they need to be doing from a demand generation standpoint?
Yeah, right. I get it. And can you expand a little bit more on the bottoms up approach? What does that look like?
Sure. So what you do is you start by taking the revenue or ARR targets that you're trying to achieve. You take then your average order value to figure out, okay, and let's just run a simple example. Let's say our target is $100,000 in ARR. Our average sale size is $10,000. So we need 10 sales. And then it works it back up the funnel to say, okay, in order to close 10 deals, how many deals do I need to compete for? And let's say we've got a 30% close rate. So we'd need 100 deals to get 10 closed won, right? And then we go back up the funnel one more step to get to 100 deals. How many marketing qualified leads do we need? And maybe we're converting half of our marketing qualified leads. So that means we need to start with 200 MQLs, and then we work it back up one more level and say, in order to get to 200 MQLs, how many raw leads do we need? And so we can then, as a go-to-market team, not only focus on improving the conversion at each step or stage, but then also figure out what programs do we need to run to deliver the raw numbers, right? The fuel for our funnel that's in there. And so that's probably the most concrete way that's universally applied against virtually every client we work with.
Yeah, nice. And so then the art becomes really optimizing each of those stages so that each can improve as well. Is that right?
That's right. So,
Yeah.
From a marketing perspective, how do I improve my my raw lead to MQL conversion, right? And that's, you do things to attract better traffic and make sure that you're speaking to your ideal customer profile and personas to make sure that you're attracting the right people in at the top of the funnel. Versus sales, who is then looking at, okay, as I go through my selling process and the buyer goes through their buying process, how am I converting at each step or stage of that sales or buyer journey?
Yeah, sure. No, that makes perfect sense. And one of the things that I see in my area of B2B SaaS digital marketing acquisition is when you can really hone in and understand who your product market fit or your ICP is and get that product market fit, drive them into the business. Obviously, that has a much bigger impact than just driving any type of traffic or the type of audiences that can get some value out of your product but not use it in its entirety. In your opinion, how important is it to really develop solid personas in order to be successful?
It's absolutely critical. Otherwise, look, there is so much more pressure on the go-to-market function right now to acquire demand cost effectively. And so, if we don't have a very tightly defined ICP and very tightly defined personas, we risk attracting not only the wrong buyer or persona, but also the wrong company. And that, probably is going to convert at a lower percentage than the rest of our funnel or a pure ICP and persona. So we're suboptimally spending money on generating that demand. So it's all about continuous improvement and unit economics and increasing our efficiency.
Yeah, sure. And obviously, Carter, you've been working for the last 4.5 years and as revenue chemists in particular, and the market's changed quite a bit since then. And, there's been a lot of talk of VC capital drying up. Obviously, some startups are really starting to feel that as well as they hit or come close to the end of their runways. How have you seen the mindset of these companies change in the past, say, like from the last 6 months compared to maybe 2 years ago?
Yeah, look, 2 years ago, it was definitely growth at any cost, right? And so it was really both in the startup environment and in the VC environment. Funds were much more readily available, and it was all about making sure you hit your growth targets, even if you had to spend more than you would normally spend to hit that target. And so it was really a willingness to continue investing at paces or rates that you might not normally invest at just to get that growth. That has changed significantly. And really where we are today is companies are driving efficient growth. And so it's no longer growth at all costs, it's efficient growth. So making sure that we're really monitoring our spend, understanding which channels are performing and which aren't, and then allocating spend to maximize the lowest cost for acquisition.
Yeah, no, that makes sense. And what's your view on, understanding CAC or cost to acquire customer across the board as opposed to like on a per channel basis? Obviously, some activity, say like running an event might be great for awareness and generating leads, but You don't necessarily close customers off like right off the back of that instantly. I see Monday.com everywhere. When I was in Australia recently, running billboards, they're on the tram, all sorts of things like that. What's your take on running that higher funnel activity, and how do you think that relates back to the overall CAC number?
Yeah, look, I always try and look at the full life cycle cost to acquire that customer. So, we're going to have events, as an example, that where you might have a higher spend, and our cost to acquire those might be slightly larger than, say, an email campaign or a webinar or something like that. But at the end of the day, it's in my mind, it's always about a portfolio approach. I have yet to see many businesses that can rely on one or two channels to generate their demand. It's always 5 or 10, and it's being able to understand how cost effectively are we acquiring demand by channel to then make more prudent investment decisions.
Okay. Yeah, no, I understand that. And it's probably a good segue into my next question. I broadly categorizing companies into early stage startups and later stage startups. One of the experiences that I have is that with the earlier stage startups, to your point, they might get away with using one or two channels to acquire customers. They might actually get fairly significant month-on-month growth, but it can be hard to continue that growth as every channel sort of reaches its own ceiling and they need to add more strings to the bow as well. Is that something that you have experienced also?
Absolutely. I think, and so I'll give you a perfect example of a channel that right now is, for most of my customers, are producing diminished returns, and that's outbound prospecting. So it's particularly in early stage companies, it's not uncommon to have them hit their growth objectives and targets through a significant portion of inbound activity. But as you kind of stated, that inbound activity is not linear, right? So investing another dollar doesn't necessarily guarantee that we're going to get another lead. There comes a point of diminishing return. And so a lot of accounts are then thinking, okay, well, I need to layer in outbound. And outbound, comes with, in most cases, some decent costs or significant costs, because you've got the system to support it. You're more than likely investing in SDRs or BDRs to do the outbound motion and set the appointment and qualify the account. So, it's very easy to invest, several tens of thousands, if not hundreds of thousands of dollars in an outbound process. The reality is outbound right now, and particularly in the US, is not producing at the levels that it used to. So as an example, I used to be able to have an SDR team that would book between 15 and 20 appointments per SDR per month. That is no longer the case. Now SDRs are, if they can get anywhere between 8 and about 13 appointments a month, that they're doing really well. So that channel has become significantly harder, almost 2x harder than it was historically.
Wow, that's a really big difference. What's your theory on why that might be?
I think, if you think about it, the primary vehicle there is email outreach. And I think the email channels are super saturated. And I think, you can probably relate to this as most of your listeners can. When you show up first thing in the morning, you open your email box and there's probably 60, 80, 100 emails in there. Well, guess what? Probably 50% of them, maybe more, are things that either are unsolicited or are things that you might be interested in but don't have the time to deal with right now, right? And so this email oversaturation means that there's a lot of static in that channel. And so it's very difficult to differentiate yourself, to create some separation, and to engage the prospect that way. So we've got to do things like a multi-touch approach and a multi-channel approach, where we're using things like LinkedIn, we're using videos, we're using calls, we're using texts, to try and create awareness and attract the prospect.
Yeah, I can definitely relate to that. My inbox seems to be getting more and more full every week, and certainly there's a lot more unsolicited email, is something I've anecdotally experienced over the past couple of years as well. So it's interesting to see how that's flowing back to the actual results generated from those channels too. Talking about early stage startups, what do you think the top 3 metrics that are most important to pay attention to for early stage startups?
Yeah, I think product market fit. So whether you choose to use the rule of 40 to identify that, or LTV to CAC ratio, making sure that you are getting good signs from the market that you can efficiently acquire customers or prospects is really important. I think obviously in early stage companies, cash flow is king, and so you've got to have a laser focus on cash and cash flow, because if you don't, you can find yourself out of business very quickly. And then I think regardless of stage, the unit economics, right? Our cost to acquire a customer, our lifetime value, some of those metrics are critical regardless of the stage you're in. In early stages, we would be looking for dramatic improvements as we learn to more efficiently go to market. In later stage companies, we may see smaller incremental change, but it's on a much larger audience, so it's equally impactful.
Yeah, and interesting, because do you believe that the same metrics are just as important for late stage startups, or are there other key metrics that you look at depending on the stage?
I think definitely some different metrics, not all of them, but in the larger companies or later stage, I'm going to be looking at profitability, right? So where are they on the profitability continuum? Are they still needing venture funds to continue their journey? Are they cash flow break even, or are they in fact profitable? Because each of those has very different implications on the decisions that get made and the investments that are done based on where they are financially and their runway. As an example, though, things like CAC, LTV, those are universal regardless of whether you're an early stage company or a late stage company. You need to have a good handle on those metrics.
Yeah, sure. And I guess to your point, cash really is king, and the LTV CAC ratio that certainly plays out throughout the run rate of a capital raise or something like that as well. How does the work you do help early stage startups to raise capital?
Sure. So in most cases, we're going in to help them either define their process or understand where we can improve their process. And so in most cases, it ends up with a couple of things. First and foremost, we're going to document that. So if a lot of times, particularly in earlier stage companies, we get in and it's kind of tribal knowledge, how to get things done and what the sales process looks like or what the go-to-market process looks like. And so part of the importance is documenting those processes and improving them along the way, because one of the challenges of scaling is bringing additional people into the business to help you operate it. And if you don't have well-defined documented processes, it makes it really difficult to onboard those folks and help them, get up to productivity and efficiently contribute to the business. So I think that's one of the areas that we consistently do. In most cases, we also are able to deliver significant improvements in conversion ratios. And so we're improving the LTV to CAC ratio significantly, making the companies more investable.
Yeah, nice. That makes total sense. And one of the things that you've touched on now is scalability. What do you think the main drivers of scalability in SaaS marketing are?
I mean, I think it's I think you've got to step back to what I call the ACH model, awareness, consideration, hit rate, right? And start to understand, okay, as we are building our brand, how many of our ICPs and personas are aware that we exist, right? Do they know who we are? Do they know what we do? If they do that and they're in a buying cycle, will they consider us? Will they, are we top of mind, and is our brand or service efficient enough to come to top of mind when they know they've got a problem that we can solve? And then the final measure is, if we compete for their business, so if they're aware of us and they consider us, how many of those deals do we win?
Yeah, I get that. And I think in terms of scalability in marketing, it makes me think as well about recruitment. And I imagine you've seen many companies scaling and many founders and CEOs off the back of that need to make their first marketing hire. When it comes to building marketing teams, what's your experience or advice in terms of the first, hire, second hire, third hire to make in a marketing team in order for a B2B SaaS company to be as successful as it can be?
Sure, and I'm going to give you a slightly biased answer, but look, I think fractional or coaching and consulting roles can be invaluable in early stage companies, simply because in most cases you're able to work with an individual that has significantly more experience and tenure in your designated area, whether that's sales, marketing, customer success, whatever the case may be. And so as a result, you get the benefit of all that experience, of all those connections, of all of that pattern recognition, so that you're not making a lot of the mistakes that other early stage companies that maybe hired or promoted from within, a early marketing person or an early sales person into leadership, and they're kind of learning on the job. So I think you get a huge acceleration from a process and experience standpoint, and it's generally at a fraction of the cost that it would be to hire that person on a full-time basis. I think the other thing that's interesting there in a lot of those relationships is that coach, consultant, fractional leader can also help you find your first full-time leader in that function. And so having somebody with that pattern recognition that's spent their career in marketing or in sales, helping you select your first leader can be invaluable, because again, they know the lingo, the terminology, and what to look for, where first-time founders, early stage companies may have less experience there.
Yeah, understood. And I think as well, to your point around fractional hires, what's really great about that is that the super early stage companies, they don't necessarily need a full-time marketing leader. It's not actually a full-time job, but you certainly do need someone with deep experience that can come in and add a ton of value. So I think the fractional or consulting approach is often a much better decision, just because you get a lot more bang for your buck. Early stage startups, as we know, are a lot more nimble as well, and it enables those companies to stay nimble. Obviously, as you build out all of your fixed costs, then that puts you in a certain position if things don't go well in terms of the current marketing plan or the sales plan or whatever it may be as well.
That's right.
Just coming to our last question now, have to talk about AI. I know that it's been explored quite a bit, but in saying that, there seems to be constant updates as well. ChatGPT 4.0 being the most recent and most exciting, in my opinion. How do you what's your advice to marketers who are daunted by the pace of the change with AI?
You better keep abreast of what's happening. Otherwise, you're likely to get passed by one of your competitors. And I think, look, this space is super hot. It's definitely in the hype cycle right now. But I think, if you've used AI at all, it can produce some pretty phenomenal things. I took a look at an early stage company last week that is doing real-time call coaching using AI. And so you can set a template up for how you want a sales call or a marketing call to flow. And you can put maybe a less tenured or less trained rep on there. The AI listens to the conversation, compares it to the template, and then suggests questions and next steps in real time for the rep. And it's still in kind of an alpha beta phase, but wow, talk about dramatically changing new hire productivity and improving our conversion rates. Technology like this is going to be just absolute game changers. And I think the reality is, if you're not paying attention, your competitors are. And so you're likely to get outflanked by a nimble competitor. So my advice is stay abreast of it, spend some time, dedicate an hour a week to getting in and playing with the tools, understanding what's out there, particularly in your ecosystem or your niche, and try and do your best to stay abreast of it, because it will mature very quickly, and they're going to be a absolute plethora of solutions out there to address whatever you're trying to do.
That's fantastic advice, and it just gave me an idea to maybe finish on a fun one. I've read online recently that when SaaS and cloud software first became at the forefront and started to become more popular, on their website everyone would make sure that they said cloud software. At the moment, it feels like just about every SaaS company I interact with now has something about AI on their website. What's your take for how long that will continue for before everyone just assumes that there's AI involved?
Yeah, I mean, and I think you can follow the Salesforce journey. If you remember the early Salesforce branding, right? It was software in a cloud, or software with an X through it, right? Or with a cross through it. And they were really probably one of the earliest companies to popularize SaaS at a global level. And so I think you're going to continue to see that happening across AI, right? And so right now it's in that hype cycle. Interestingly enough, customers are becoming much more savvy. And so even if you put AI in your literature or your website or whatever, you better be able to demonstrate it, and you better be able to talk about, not only what you're doing today, but what that roadmap looks like. I was on a call with one of the companies I work with, who is just started to dip their toe in AI. And of course, they've got it on their website. And this prospect said, "Hey, great, I see that you're experimenting in AI. I want to have a deep discussion about exactly what you're doing and how you're doing it before I'm willing to invest." So I think, just putting it on your website or putting it in, attaching it to your product, while it might work right now, won't in the long term. And I think my guess is that Salesforce adoption for cloud software was probably a 10-year journey. I suspect that the AI journey is more like 2 to 3 years.
Yeah, it's certainly something that I'm noticing consistently across people that know a lot more about it than me or have a lot more experience, is certainly that the rate of adoption is going to be much quicker. Carter, that brings us to the end of the interview. I've really enjoyed chatting to you today. You're very knowledgeable in this space. And yeah, I wish you all the best for your next steps. Anyone that's looking to get in touch with Revenue Chemists, I'm sure, Carter, LinkedIn is probably the best way to reach you, otherwise via your website, right?
Yep, LinkedIn, website, or carter.perez@revenuechemists.com is my email. So make it super easy.
Awesome. Hey, have a great rest of the day.
Thanks so much, Ryan.